What if you had $1,000 to invest today? Would you put it in stocks, bonds, or a mutual fund? All three can help you grow your money, but they work very differently. So in the next few minutes, let's break down stocks versus bonds versus mutual funds in the simplest way possible. Part 1. Stocks. Let's start with stocks. When you buy a stock, you're buying a small piece of ownership in a company. For example, if you buy shares of Apple, Microsoft, or Amazon, you become a tiny shareholder of that company. The biggest advantage? Growth potential. If the company performs well, the stock price can increase, and you can potentially make money. Some companies also pay dividends to shareholders. But there's a catch. Stocks can be volatile. Your investment can rise significantly one month and fall the next. So stocks generally offer higher growth potential, but they also come with higher risk. Part 2. Bonds. Now let's talk about bonds. Think of a bond as basically lending money. You lend money to a government or corporation, and in return, they typically pay you interest. For example, you might buy a U.S. Treasury bond. Instead of owning part of the company, you're essentially becoming a lender. Bonds are generally considered less risky than stocks, although they're not risk-free. The trade-off? Usually you get lower growth potential compared with stocks. So if stocks are about growth, bonds are more about income and stability. Part 3. Mutual funds. Now here's where things get interesting. A mutual fund is like a basket of investments. Instead of buying individual stocks yourself, a mutual fund can hold dozens, hundreds, or even thousands of different investments. For example, one mutual fund could invest in companies across different industries. You buy shares of the fund, and your money gets spread across its portfolio. This is called diversification. And that's one reason mutual funds are popular with beginner investors. You don't have to research and buy hundreds of stocks individually. However, mutual funds can have management fees and expenses, so it's important to understand what you're paying for. The big difference. So, what's the difference? Think about it like this. Stocks equals ownership plus higher growth potential plus higher volatility. Bonds equals lending money plus interest income plus generally lower risk. Mutual funds equals a basket of investments plus diversification plus professional management. And here's the important part. You don't necessarily have to choose just one. Many investors use a combination of stocks, bonds, and funds based on their goals, risk tolerance, and time horizon. So if you're just starting your investing journey, don't focus only on finding the investment with the highest return. First, understand risk, diversification, fees, and your financial goals. Because the best investment isn't necessarily the one that made the most money last year. It's the one that fits your financial plan. If this video helped you understand the stock market a little better, like subscribe and follow for more simple money and investing content.